Do you know what I mean when I say unrealized loss?
No.
Okay. So all good, all good.
You guys know I'm a complete beginner when it comes to stocks. So to help me, I've been using a trading bot, specifically Peakbot. And if you guys would like to see weekly results, let me know in the comments.
Okay, yeah. So this right here, this is what I had questions about.
Okay.
Because I was just like, okay, I don't know what this means.
Sure.
I know that right here, like I sold run at 1834, and then yeah, from there I don't really know what happened. Like I guess I gotta sign the contract.
That's getting assigned. Yep.
Okay.
So whenever you see a big negative like that, that's you getting assigned the shares at your strike price. And it's taking your cash and it's putting it into the position. So that's not you losing money. That's just you, gaining the shares, right? So, and what we can see here is anytime like on the 821, where it says sold one run August 25th, that's telling you, okay, you own the shares now. We're going to sell a call, which is why it says, 15 call.
Oh, right here.
Up a little bit on 820. Sold one run August 25th. So that's a call, right? Because that's a covered call where we own, you got to sign the shares. We still want to collect the premium. So we're going to sell a covered call at that strike price, which is what you're showing there. All right. So,
which is this right here, right?
That's correct.
Okay.
Yep. So, and then on the 28th, so you didn't finish above the strike price, so we sold another call on the 28th the following week, right? And that's what you're collecting in premium.
Right here.
Yep.
Okay.
So, and then you can see on the 5th, we actually finished above the strike, so we sold 100 shares.
Cool.
And then
because it was at 0.21 instead of at 0.16.
Correct. Yeah, at some point it finished above your strike price and we got rid of the shares, and that's why you can see on 9/5 now it starts again over with the put because you don't own the shares and it's going to use your cash to open up that contract.
Okay.
And then you can kind of see we've been going in and out of getting assigned versus unassigned. Well, that's not technical. I have it set for the last quarter. I don't know if you've been, yeah. So if we look at the last quarter, this is showing you, okay, if we go all the way back here to August 1st, this is your first contract here with Run, and it was a put, and you made $38 in premium on that. Then, let's see. Then the next week you made $17, the following week $19. Then we got assigned shares, so then it's selling a call, and this is the premium you're collecting from the call. And then it has it all added up here for you, right? So the realized gain and loss here, this is an easier way for you to come in and see, okay, I've made 14 trades, 14 contracts, and this is what you've made in premium in that time period.
That's cool.
Yes.
What's
yes.
that, like 10, 14%, I think?
Yeah, so I'm not sure. I think with your Run contract, you really only, I think, allocating about $1,000 at a time, because I think it's around a $10 stock. So yeah, if we were to take into consideration the $1,000 that you're trading over the last quarter, yeah, you've made 246 bucks on that 1,000. Now that's just in premium. That's not taking into consideration any unrealized gains or losses. So what we can do is, if you wanted to pull back up your TD Ameritrade account, we can look at your current positions. That way we can see if there's an unrealized loss in the shares that you're holding. Do you know what I mean when I say unrealized loss?
No.
Okay. So all good, all good. So when we lose, go ahead and click get out of this and go to just my account and positions.
Okay.
Yeah, positions. So go ahead and scroll down. Let's look at this position here. So you can see run over there on the, yep, now on the right hand side, you can see the gain of negative $300. Okay. So that stock has unfortunately, once you get assigned the shares, if we lose a contract, right, if we finish in the money, you get assigned the shares. So right now you're down $300 on this position. However, you've made 246 of that in premium. So you're almost break even on that. And if you continue to collect premium every week from run, you're going to outweigh your losses that you incur along the way. So that's the beauty of this strategy. Sometimes you're going to pick the wrong stock at the wrong time, which happens to be the case here. But if we collect rent every week, of course, we're going to get out of that hole eventually, right? So that's, I guess if we wanted to net this out for you, you're down about $54 since running this on Peakbot. Now, that when you're only running one contract on one stock, it's, you know, if you pick the wrong one, and again, you're not the only one in Sunrun. Believe me, I'm in it. A lot of our traders are in it. This market's been pretty rocky. So what we've done to actually counteract this is we've built in a new feature into the wheel strategy, Lauren. So we've built in what's called a credit spread. Have you ever heard of something like that before? Okay. So what that does is it's essentially insurance. It's acting as a hedge. Okay. So right now, when we are running, this is called a naked put or a naked call. Okay. Because you're just selling a call or a put. What we're doing now is instead of just selling a call or just selling a put, we're actually selling and buying a put simultaneously at two different strike prices.
Oh, okay.
Yep, which provides now a max loss. So like for Sunrun, you know, we're down 22% on that position just because the stock, you owned it at, let's see, current market value is 1,039, but your cost is 1,339. So you've lost $300 on that over, I know you've been running this since August. So all things considered, obviously we'd rather be in the other direction, but this has been a losing stock. One thing to note is Sunrun this week, okay, it's number 2 on our watch list, and it's paying a 3.63% in premium this week alone, which is a great return. Why is the premium that high? Because they're reporting earnings this week.
Gotcha.
Typically, Lauren, whenever a stock is reporting earnings, I like to avoid it like the plague.
I'm already in it, so it's like, whatever.
And guess what? Guess what? Right now, it looks like a winning bet. Now, I'm going to knock on wood and not jinx you here, right? But when stocks are in an earnings report, stock typically does this or it does this.
Right.
So right now, it looks like you're on the winning side of that. The stock price is at $10.36, yet your strike prices are at $8 and $6.50. So you're well above, right? So now, if I'm going to pull up your screen here, I'll for a second. I want to see your strike price is at 10.5. Okay, so we're selling a call at 10.5. Right now, it's at $10.36. If that stock finishes above 10.50 tomorrow when the market closes, again, right now it's about 14 cents away from that. You're going to get rid of those run shares finally. You've been holding them for quite a while. You'll get rid of them, and then we'll start over again on the put side of things. But even if you don't get rid of those shares, you're still collecting this week, more so than others, a really nice premium on run, about $29 worth, which on the cash that you use to set aside on that contract is a pretty nice premium, right? So what I was talking about with the credit spread, okay, so we're selling a call credit spread here. Now, we don't have the details on the call side on this watch list. That's coming very soon. But let's assume you're on the put side, which means you don't own the shares like we did when we started this, okay? So if you didn't own shares of Run this week, all right, then your strike prices, and right now in your Peakbot account, this isn't, you're still running an unhedged wheel. I want to hedge that for you, and we can do that now, or we can do that in a couple minutes. So all this to say is we are now going to be choosing 2 strike prices on every contract, basically acting as insurance, right? So let's say this stock for Sunrun this week started at, I don't know, let's just call it 950. If we stayed above both of these strike prices, that's best case scenario, right? Because we won our bet, we collect our premium, and we move on. Okay. If we finished between these strike prices of $6.50 and $8, you would get assigned your shares like you normally would. Again, I'm talking on the put side right now, only because we don't have the call information on this watch list. Again, coming very soon. But if that stock finished between $6.50 and $8, you end up getting assigned your shares, just like a normal put or a call, right? You get assigned. Now, as you can see, with this hedge that we've built with this credit spread, we now put in a max loss. There's only a certain amount of money that we're going to lose on this contract regardless of how bad it gets, because that 150 comes from the spread between these 2 strike prices. There's $1.50 between this price and this price. So $1.50 times 100 is $150. Right? Why do we multiply it by 100? Because there's 100 shares of this in this contract, right? So that means, God forbid, the stock was to fall below 650 this week. You don't have to worry about that stock continuing to plummet, because we actually bought that strike price as opposed to selling it, which means as soon as it goes under 650, we don't get assigned the shares. We just, right? So that's why there's the credit spread with the 2 different strike prices. Is that kind of making sense?
I'm gonna go back and listen to it.
Okay. All right. Cool. So,
can we go back to what you said? You said something about the price is like 14 cents away or something like that.
Yeah. So right now, if we're looking at your TD Ameritrade account, where it says your options thing, so it says run November 3rd, 2023, 10.5. Okay. Right before the call, it says that in your TD Ameritrade account here.
Good. 10.5. Okay.
Yep. So that 10.5 means that's your strike price, $10.50.
Okay. So it needs to be above that
in order to get rid of those shares. Correct.
Right. Okay.
Yep. And if it doesn't finish above that, then you're going to hold your shares.
So say it ends up like at $10.60, right? So that means that 1060 would be in my account.
That means that the shares that you own right now, even though it's at a loss, because if you look at your shares for run right now, you have a $300 unrealized loss. The reason it's unrealized is because you haven't sold it yet. It's not a realized loss because you can't sell if you can't lose if you don't sell.
Right.
But the second you sell those shares, you will have now a realized loss, because you can, in the wheel strategy, you can sell your shares away for less than you got assigned. We'll take that loss, right? Because we're still collecting premium every single week. That goes back to the rental property example, right? Where it's like, hey, sure, we're going to have losses along the way. We're going to make some bad picks. But if we can collect 0.5% here, 1% there, 2% here every week on these contracts, like I showed you in your premium before, you've made almost $300 in premium since running this contract. So you're almost break even here. So you'll get rid of those shares. We'll start on the put side of things again, because you don't own the shares once you get rid of them. And so I don't want to ramble.
Where would I see that? Would that be like where I was looking before, where it was like doing like the transaction history?
Yeah. What exactly were you wanting to see? I'm sorry.
Okay, so you know how on Peakbot, I think it says like plus $19.
Yeah.
So, okay, like for the first one, it says like plus 38, 17, 19, and all that. So I would see those plus numbers on my TD Ameritrade account, like under like.
So here's my orders. Now, these top four is a different strategy. That's an iron condor that I'm selling on the SPY. However, you'll notice here with MGM, okay? So I'm actually selling and buying a put here, right? So I bought the 31.5 put and I sold the 33.5. This tells me how much I made in premium right here. So this is 0.09, that's $9.
Okay.
If this is 0.38, that's $38 I've made in premium.
Gotcha. Okay.
That's an easy way to look at it here. So I know on Uber, I'm sorry, when you're buying it, you're actually paying that premium. So I'm paying $9 for that, but I'm making $38 to sell it.
Okay.
So that's the credit spread. That's where we're essentially buying and selling as a hedge to create a max loss for us and an insurance policy almost. So I'm doing that for each of my positions. So what we want to do for you is your contract is unhedged for this week. And it's like that because you were running this before we made the update to the platform.
Right.
So we weren't going to just automatically hedge it for you without you knowing. But now all you need to do is click in here. And if you turn on the hedge for next week, you can do this now. It won't have an impact on your contract for this week. I'm not going to do it for you. And then what that's going to do for you is next week, if we don't get rid of these shares this week, and you're still on the call side, then you're going to be selling what's called a call credit spread next week. Yes, now it's hedged.
Okay.
So you're good there. Now, that, again, not going to have an impact on the contract you're running this week.
Right.
But for more information on how this all works, we updated our website. Okay, so now we've got a ton of good information here. And what it's going to show you is the entry and exit details. Okay, so this is where you would be. Let's assume you don't get above that 1050 and you own the shares again next week. We're going to sell a call credit spread. Okay, so what that's going to do is the bot's going to sell a call at the strike price that's closest to and less than the 50 delta. And if you're not familiar with the deltas, or anybody who's watching this who might not be familiar with the deltas, get familiar. Really, the deltas is just determines how much you're going to make in premium and what your strike prices are. Okay, so what we used to do prior to this is we used to just sell the 25 delta. Again, that's a naked call. There's no real protection for you if the stock does something out of the ordinary. Now we're actually going a bit further, and instead of selling the 25 delta, we're selling the 50 delta. Okay, so that's our long call, and then we're buying the 20 delta, which is our short call, just in case the stock dips pretty. Over the next, let's call it month or two, we're going to be releasing a new bot that's going to automatically be the fan favorite because it's just an enhancement of these strategies that we're running now. Rather than just
futures bot.
What's that?
I can't wait till y'all have the futures bot.
I know. People are dying for that, and we're not far off because futures and options share a lot of similarities. So this new bot's going to be called the Trend Spread Bot. Okay, so essentially what that does, Lauren, is it determines the trend of the market. If it determines we're in a bullish market, we're going to sell a bullish strategy, a put credit spread, saying that the stock's going to go up. If we're in a bearish market, we're going to sell a call credit spread, saying that stock's going to go down. And if the market isn't really trending bullish or bearish and it's more neutral, then we're going to sell our neutral strategy, the iron condor, which ironically is both a put credit spread and a call credit spread at the same time. In order to collect premium on a weekly basis. So what's that?
I said, sounds good to me.
Yeah, collecting rent. We're gonna keep chopping here. You know, people gotta think that you gotta treat it more like a 401k, right? Like it's really easy to log into your account every day or every week and and get excited or get, drive yourself crazy based on the current results. But the point is, if you're collecting, let's just call it on average 1% a week in premiums, you know that at the end of the week or at the end of the year, you'll have made 52% in premiums on average. Mm-hmm. Now, that's not the world we live in where everybody just returns 52% every year, right. But that's when you take into consideration those unrealized losses. That brings you back down to reality, right? So, my account, I'm at about 28, 29% year to date. Mm-hmm. And if you were to look at my account, it looks like a bloodbath right now. I mean, I'm sitting in a lot of positions that I'm just holding, that I'm down on, but I'm okay with that because I believe in the stocks that I'm trading, and I know I'm collecting at least 1% every week from these stocks from just selling these options contracts. So I know, again, rental property, the longer I charge rent, the quicker I'm going to outweigh, any losses that I incurred along the way.
That is hands-free trading. So if you are interested in using Peakbot, they do have a 2-week free trial. Everything that you need will be in the description. They will call you and help you set everything up. If you have any questions, you can ask them as well. And if you have any questions, you can leave them in the comment section below, or you can watch this video right here.